there's a key, the mechanism is the same, but there's a key difference. FTX is a brokerage. They're supposed to keep customer deposits separate, and they don't have a right to use yours. A bank is in the business of using your deposit to make bets. And back in 2020, the Treasury changed the rules and said you don't need mark-to-market accounting because the bond market had become illiquid. And that was okay, but it compounds this issue once depositors leave. So yes, there is a comparison that you took customer money and you made a bet. One is actually allowed, the other one's not allowed. There's also a lot of regulation about what kind of bets you can take. We stopped the ability to have prop trading in banks. That went by the wayside a while ago. But FTX was essentially prop trading with customer money, which they shouldn't have done, which was kind of more what MF Global did when John Corzine essentially took brokerage deposits and bet it on the European bond market and blew up. And he shouldn't have done that. He was allowed to do it at Goldman, but it's a different business. Brokerage, you don't get the rights to use the customer funds. In a bank, people don't realize is you are the product. And that's very different.
Bitcoin gradually moved to just under $28,000 on Thursday as traders digested the quarter-point interest rate rise Wednesday by U.S. Federal Open Market Committee, FOMC, in line with expectations. The decision reinforced the Federal Reserve's concerns that inflation remains problematic and that it remains strongly committed to returning inflation to our 2% objective. Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul updates about his outlook for blockchain technology in 2023. Raoul also breaks down the reason for the banking crisis and what's going to happen in the next few days.
So we've seen the bond market goes up and down, as all assets do. But bonds are kind of different because they guarantee to pay you back. If it's a US Treasury bond, they can't go bust because they can create money. So they guarantee to pay you back. So if a bond is trading 90 cents, at the end of maturity, it'll mature at 100. So what the Treasury said is, okay, fine, they move around. You are in the business of long-term investing, so we'll assume you're going to hold it to the end. So therefore, you don't have to accept the volatility in your portfolio, which creates other problems with profitability and other issues. So they changed the accounting rules. So that's the hold to maturity model. Mark-to-market model means that bank balance sheets go up and down and their regulatory risk capital goes up and down depending what the bond market's doing every day. Now, we would have blown up the banks earlier if they had mark-to-market accounting, which is every day you mark your books, because yields went up too far and the Fed had essentially told them they're not going to raise rates. So they all got into the bond market. It's their job. It's what they do. They essentially provide liquidity to the Treasury to buy bonds, and they were massively offside. And that happens from time to time. It's a function of financial markets. But the hold to maturity allows you to paper over the cracks and forget you got the bet wrong. Mark-to-market accounting means you have to take the bet as it happens and the losses. But what happened in this situation is the depositors leaving means you have to collapse this side because you have leverage requirements, and therefore this side, suddenly you've got, oh my God, we've got these huge losses. So it turns hold to maturity into mark-to-market in seconds, and that's a problem. At every bank, there's a bunch of people who run the capital of the bank. It's their fucking job to make the right risk. And they got it wrong. Not because the Fed told them anything. Their job is to look forward in the business cycle and make a decision. Do they think rates are going up or not? What really happened is what nobody had on their bingo card was Russia invading Ukraine. That's what caused the next big leg up in the bond market. So 10-year bond yields, I'm just looking at my chart now, they were chilling at about 1.75%. Russia invades Ukraine and they hit 4.5% 10-year bonds. That was the thing that nobody had. And that was the thing that broke the banks, because they were like, we're pretty comfortable. Maybe bond yields move, 100 basis points. That's all fine. We got hold to maturity accounting, no problem. Russia invades Ukraine. massive supply shock, suddenly bond yields explode, the Federal Reserve have to fight it. Everyone was offside. And it just happens. But the question I would say is, and this is a contentious one, is did the Fed have any business raising rates as much as they did? Or would the economy have slowed down anyway because inflation ate into everybody's pocketbooks, companies started to see slowdown in growth anyway, and the supply chains were starting to ease up, so inflation probably would have unwound significantly. So should the Fed be at the kind of level of rates that they are at, or did they screw that part up? And my view, which is opposite to most people, is I don't think they should ever have raised rates this far. It was stupid. Other people say, well, they shouldn't have kept rates this low. I don't know, because the economy, trend rate of growth in the economy is like 1.5%, 1.75%. Things are really slow. We're straddled with debts. And we've seen every time we raise rates, the economy collapses. And it's not now just a general recession. We expose some big ugly, which is some leverage under the rug. Everybody knows, including the US. I mean, I've spoken to people at the Department of Defense. Everyone knows that the issue that the US has got is debt. And so they know that they've got an angry population, they've got debt, and you can upset the apple cart pretty quick. So I think Russia kind of knew some of the economic outcomes. And then in retaliation, what we did was ridiculous because we also took, I mean, fine, have sanctions, no problem, do all the things you want to do, but taking people's private property without due process was outrageous. Taking, essentially neutralizing the reserves that they have in dollars sows the seeds of demise of the dollar-based system. Now, it's a long way off because 87% of all world trade is still in dollars. But when you tell somebody your dollars that you've put your country savings in are now not accessible, and by the way, your private property is going to be stolen from you, okay, that's not good too. Now, we've also got another geopolitical financial warfare that we know could blow up at any point, and that's obviously China and Taiwan. And the reason why that's so important is the entire world has one big bottleneck. Well, energy is one bottleneck, silicon chips are another. And Taiwan is like the Saudi Arabia of silicon chips. And he who controls the chips controls the flow of data. And so that's another one. And so I think we've seen from online activity from nefarious states that they understand that the fabric of society in a democracy in a situation like this is more fragile than in an authoritarian state because the state can clamp down on it. So it's harder for us to break Russian society. In fact, it's almost impossible, as Napoleon, Hitler, and everybody else has tried to find. And it's really hard to break Chinese society, but it's much easier to break US, UK, or European society. So there's a psychological warfare, financial warfare, physical warfare, and a cyber warfare all going on at the same time.
So what are your thoughts about Raoul Pal's explanation of the banking crisis? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.